that's really the question right now, and I think a lot of people are starting to ask that question when it comes to the potential risk out there and whether investors are looking past those risks. Kathryn Rooney Vera joins us right now. She's Chief Market Strategist at StoneX Group, joins us here in Studio 2 to count us down to the close. Kathryn, I do want to start off with risk and whether you actually see any sort of meaningful problem with this, let's just call it a record rally, off those April lows that have been driven by a relatively small cohort of companies.
Well, yeah, there's inherent risk. The market is really not discounting the more structural risk, which I consider to be crowding out of the private sector. You see that in the Treasury market, you see that in the housing market, you see that in the U.S. dollar. And this is essentially what it's doing is it's a tightening of credit conditions, and it's keeping real yields high, and probably, in my view, will go higher, meaning the back end moves up and continues to move further. What's happening is that there's, an influx or rather an outflux of Treasury issuance at the short end, and it has to be rolled over. So we have $7 trillion coming to be rolled over in third quarter, plus additional new issuance that was announced today, about $450 billion, with the price-insensitive buyers, which are the central banks, the Fed, China, Saudi Arabia, Russia, stepping back, forcing the private market, us and everyone watching, to step in and to finance those or to buy that paper. We're requiring a higher premium, and I think that trend is just going to move higher.
Well, but we have not really seen that premium, certainly not on the long end of the curve, at least on what you would expect it to be on a relative basis, not only relative to other parts of the curve, but even relative to other assets out there. I mean, you look at the differential that you're getting in the Treasury market versus maybe potentially in equities, it's pretty tight still.
Yeah, but this is a short-term funding issue, and what we're seeing is the administration attempting to fund deficits with short-duration paper and getting revenues from tariffs, and that's going to be a tough equation to follow. So I think that what we're going to see is additional pressure on the back end as fiscal deficits not only don't get corrected, but potentially worsen. So that's why I'm bearish long duration in terms of the Treasury market and prefer shorter duration and the belly of the curve.
And what about cross-asset? Do you just remain in the short term or belly of the curve when it comes to bond market, but where else?
Look, I think in the equity space, there's still value to be had in industrials, especially in defense. I still like gold. I think in the FX market, there is value in the Brazilian real. You talked about that just before I came on, as well as in Mexico. And so I do like Latin America in terms of equities and foreign exchange. And European equities have done phenomenally well, and we think they're still a hold.
How does the US dollar speak to all of that?
Yeah, the U.S. dollar, look, I think that structurally we should see a continued weakening given the twin deficits that are really not getting any better. And this crowding out of the private sector, as I referred to, what that means is that, the private market is going to see less investment, and that's not a good thing. And companies then therefore see a squeezing of their margins. So I think that when we're looking at earnings for this second quarter, what we're going to see is margin pressure picking up, not a question of demand, but more a question of costs and margins.
I am curious about foreign buyers of U.S. assets, particularly in the equity space, because there's been a lot of talk. You mentioned the outperformance in Europe, and there are a lot of people that like to point out, too, that the outperformance that some of these folks are getting on a exchange rate adjusted basis is even greater than what the actual numbers on the screen are. When you look at an S&P, basically 10, 15 points away from reclaiming its record high, do you chase that rally, or do you maybe pull back, maybe sit on the sidelines, or even worse, maybe do you actively sort of bet against it?
Well, Europe is still trading at a discount to the U.S. and to historical valuations, so I do think there's potentially still upside.
I mean, that's
there.
been happening for a decade, hasn't it?
Yeah, it has been a value trap, but what we've seen is outperformance so far this year. My answer to you would be that yes, I do think there's additional upside there, but even more so, Romain, in the Latin American space, in the emerging space, because Brazil, for example, is a primary beneficiary of this trade war and of tariffs, and as well I do expect to see a change in management, let's put it, in the political spectrum in Brazil, so I think there's additional upside there, but I do agree, of course, that capital, the U.S. exceptionalism trade is priced in.
What about alternatives? I mean, what's so interesting, on the day that we get a $4 trillion public company, we also get a record for a private company with $400 billion valuation on SpaceX being reported. But you're someone that we also turn to for crypto advice. How much are people looking to get into the private markets or indeed into crypto?
Smart money is looking at alternatives, and I think rightly so, because you get additional diversification, and historically they actually do outperform on a risk-adjusted return basis versus the public market. So yeah, I do think you want to be looking at structured notes, private credit, private equity, infrastructure makes sense to me, real estate, and potentially some cryptos.
All right, Kathryn, great to see you again. Kathryn Rooney Vera, Chief Market Strategist over at StoneX Group, counting us down to the closing bells.